everybody's got the workbook this evening. We've gone with a little bit of a different format this evening. There isn't detailed notes. It's a case of lots of numbers this evening. I'm not going to apologise for that because we are talking about saving tax. So there's a number of case studies. We've done a lot of research in this area. It's obviously something really, really new to our profession. We think that we're very ahead of the game. There's been no training courses for us as professionals in this area, and no other accountants are really talking about it other than saying it's here and it's going to happen. So not everything that we're going to talk about tonight is going to be relevant for everybody, because I've got a really wide cross-section of people in the room. So your brain can have a rest during those points because you might need it after a couple of the sections in here. In your workbooks, there's space for questions and discussion points and action points that you might see as relevant for your business. Please make notes. As I was saying to one of our clients today, these are case studies, so we need to think about the application back into our own businesses as to what is relevant and how we're going to apply all of that information. But basically, as the title of the sessions goes, we're here to beat dividend tax. Okay, so thank you ever so much for joining us. The first part of the session this evening is going to make sure that we're all thinking about the same facts and we all have the same information. I'm going to take questions in 3 chunks tonight. A, to give my voice a little bit of a rest. Help! Laura's on standby. And secondly, just to give us time to process and think about some of the things, because A, it's very new to us, but it's even more new to you. Let's get started. What is a dividend? Well, if you own shares in a company, you can get a dividend payment. Dividends can be paid to the shareholders of a company. So we have to remember that a shareholder is not necessarily a director, and vice versa. So the shareholders are the individuals who own the company. So a dividend is a distribution of the post-corporation tax profits of our limited companies. So if we don't make a profit, we can't pay a dividend. So I always see as a dividend as, well, it can't be a fixed amount therefore, can it? And it's a return on our investment. It's what we get back for the reward and risk that we take as entrepreneurs who own a business. So dividends from all of us in our small companies have to comply with company law in exactly the same way as if we receive dividend income for a company listed on the FTSE, such as Aviva. Let's talk about share classes. So when we declare a dividend in our company, we declare that dividend on a specific share class. And a company can have numerous share classes issued to different shareholders. So if we take an example of my company, Coalesco Accountants Limited, it has 1 shareholder with 1 ordinary share. So if at the end of a quarter I was going to declare a dividend, my paperwork would say I was going to declare a dividend of £5,000 on 1 ordinary share. As opposed to that, a company may have 100 ordinary shares and 2 individuals may own them. And so they may have 50 shares each, and they would declare a dividend at the end of the quarter of £50 each, and each of those shareholders would have a dividend of £2,500 for that quarter. So for tax planning purposes, some companies issue different share classes. It's not something that a lot of us did when we set up our company. It can be done for various reasons, and when we do this, we tend to do it for things such as to declare different dividends to different shareholders, maybe to have non-voting shares within our company, or to give shares perhaps to employees or other family members. So we can have a company with lots of different share classes. We can call them whatever we want to call them. We usually go for alphabet, A, B, C. And the rights that are attached to those shares are set out in the company's paperwork, the Articles of Association. So what we can then do is we can declare a dividend, maybe at the end of a quarter, where we have an ordinary A shareholder who receives a dividend of £5,000 and an ordinary B shareholder that receives £2,000. This is really important when we think about the tax planning and the dividend distribution in our companies going forward. So let's get the facts right. So the rules on dividends to the 5th of April 2016, those rules that we've all worked with basically since we had our companies, haven't changed. The bands may have changed, but the underlying principle has always been that the vast majority of us in this room actually haven't paid personal tax on our dividends. We've restricted the amount of money that we've taken out of our company, and we've taken a salary to use our personal allowance. So in this tax year, the tax year to the 5th of April 2016, most of us are taking a salary of £10,600 from our company. If we take the balance of our earnings of £28,500, that dividend isn't subject to personal tax because we don't become a higher rate taxpayer. So we've never paid tax personally on dividends until we've become a higher rate taxpayer. If we cross that boundary, we've paid tax at 25% on that top slice of our income. So anything above our salary at £10,600 and our dividend of £28,500, that top slice, we've paid an effective rate of tax of 25%. And that's what we need to remember as we plan what we're going to do between now and the 5th of April 2016. The reason that we're all here this evening is the rules are about to change. The rules from midnight on the 5th of April, so the 6th of April, the new tax year, mean that HMRC have decided that small businesses should pay more tax. And the rule changes in their proposals mean that we're going to pay an additional £6.8 billion of tax into the tax system. Let's hope not much of that comes from my clients, okay? So what are they doing to us? From the 5th of April 2016, the notional 10% tax credit on dividends will be abolished. We will have a tax-free dividend allowance of £5,000. Interesting. Above £5,000 will be taxed at 7.5%. So up to £32,000 worth of dividends in total, we'll pay tax at 7.5%. Thereafter, we pay personal tax on our dividends of 32.5%. And if we're in the minority and we're an additional rate taxpayer, that dividend that we declare on the top slice will be subject to tax at 38.1%. And as I say, dividend will continue to be treated as the top band of our income. So how much are these new rules going to cost us? That's what we want to understand in real terms, isn't it? So the first page of your workbook is called the cost of the new rules. So let's talk through this. So basically what we can see there is an example, and we start with a table that shows the new rules, the rules from the 6th of April, and we're looking at the tax year ending, therefore, the 5th of April 2017. So after I've taken my salary from the company, if I use the case number 2, I'll have profits of £37,500. I'll pay corporation tax at 20%. The rate of corporation tax remains unchanged, so we will continue to pay that tax at £7,500. From a personal point of view, in my example here, I'll be paying myself a salary of £11,000 to use up my personal allowance going forward. And that means that I have a dividend available to take from my company, being the difference between my profits before tax and my profits after tax. It leaves me the 30k to distribute. I'll have total income of £41,000, and we can see there for the first time that means I'm going to have a personal tax liability. And my personal tax liability for that year on a dividend of 30k is £1,875. What I've done, and I'll do throughout this presentation, is I've added back my corporation tax because I really want to see how much I'm paying the government. Well, I'll be paying £9,375 in total from my business and from me personally. If I compare that in the table below and say, well, I take a salary of 11k this year. I won't, that'll be 10,600. I'll have my net dividend of £30,000. And remember when we said that the notional 10% tax credit will be abolished? Well, when I was calculating my personal tax for this current fiscal year, then my dividend on my tax return would show at £33,333 when I gross that up. If I add those two figures together, I have total income of £44,333. I'd have paid a little bit of tax. I'd have paid £348 in tax. My total tax bill with the corporation tax that remains unchanged, 7,848. So the impact of me running what I consider to be quite a small business here, £30,000 worth of dividend, is that I'll be paying into the system £1,527 more per annum than I've been used to. You can see the 4 case studies in that table, and you can see where you or your business or your fellow shareholders fall into that. So you can start to do some basic calculations on that page of the impact of the new rules. When we declare a dividend, there should be an amount of administration that we undertake. The company secretary is responsible for the administration and the paperwork maintenance for your limited company. Many of us don't have a company secretary. It's not a legal requirement under company law. So as a director, we're responsible for maintaining that paperwork. I think the administration of dividends is going to become even more essential than it has been in the past. And when we make that dividend declaration, the directors should be having a meeting to declare that dividend. If I'm a sole director, I should be making a resolution, a conscious effort to sit down and have paperwork that supports not only my company accounts, but my personal tax return. Uploaded onto the website, our website, are 2 documents. There's a dividend voucher and draft minutes of a meeting. They are also in your pack, Appendixes B and C, and at Appendix A in your pack there are a number of hyperlinks that you can go through and refer back to in your notes. Why I think this is particularly important is I think that many people are going to look at the different share classes and are going to start playing a little bit more with the dividends than we have done in the past to make sure ourselves and fellow shareholders are in a more tax advantageous position. I think therefore the target of the revenue will be to start looking at personal tax returns of directors in a lot more detail. So we want our audit trail and our paper trail to be absolutely squeaky clean for each of our clients. If you need any support in this area, please don't hesitate to shout me or Laura. Another administrative burden that actually may come with the new dividend tax rules is that, for various reasons, a number of shareholders actually haven't had to complete a self-assessment tax return in the past. For a number of clients, actually, over the years, we've completed self-assessment tax returns for director shareholders, and HMRC, after 1 year, have said, thank you, we don't want that anymore. And that's because we didn't actually pay ourselves enough dividend to pay tax, and they couldn't be bothered to cope with the volume of paperwork we were providing. However, that's all set to change. Anybody that has a dividend of £5,001 or more will need to complete a self-assessment tax return because we'll have to declare our dividends on there. So if you've not all registered and you're not already on the system for self-assessment, then again, in your pack at Appendix A, there's a hyperlink of a nice email wizard that you can complete on the HMRC website to register yourselves as needing to complete a self-assessment tax return from the 6th of April 2016. If you do go through that registration process and you would like us to help you complete your self-assessment tax return, could you let Laura or I know so we can start chasing you well in advance of the deadline? Talking of deadlines, when am I actually going to pay this personal tax? The first year all of these new rules come into play will be the tax year ending the 5th of April 2017. So the tax liability falls due on the 31st of January 2018. The deadline to actually file your self-assessment tax return is the same date. What many people haven't actually considered, and the press spend all their time talking about the wrong subjects sometimes, is actually when we're considering self-assessment and personal tax, there's something called payments on account. If any of you have been self-employed in the past, you'll remember the burden that payments on account bring with them. So in your pack, we have an example of how this is going to hurt our cash flow. So payments on account of personal tax. So when we make our first personal tax payment, which we've agreed is going to be on the 31st of January 2018, you may actually also need to be paying tax for the year ending the 5th of April 2018 as well. In the example in your pack, what you can see is we have calculated your tax liability for the year ending the 5th of April 2017, and that figure is £1,875. We know from our last slide that the payment of that is due on the 31st of January 2018. But what we can also see is due is a 50% payment on account for the year ending the 5th of April 2018. So I don't just need to pay my tax of £1,875, my cash flow is going to be hurt because I'm also going to have to pay a payment on account of £937.50. So my tax payment due on the 31st of January 2018, if I do nothing, will be £2,812.50. So we need to save a little bit harder than maybe we thought we were going to have to save. We also have to pay tax twice a year when we fall into this payments on account system. So on the 31st of July 2018, we have to make our second payment on account. So you can see there's another £937.50 to pay. Payments on account only apply where our tax liability is calculated at greater than £1,000. So where we have the figure of 1875, if that was 975, we wouldn't have to worry about payments on account. If you know that something in your business has changed and your income will decrease in that following year, we can make an application to decrease our payments on account. We can make an application to either reduce them or take them to nil, say if we finish trading. However, if you make a mistake in those calculations and you underpay your tax after making that application, they will charge you interest.